Welcome to This Explainer. Today, we're launching a full-blown investigation into the most shocking single-day market collapse in financial history. We're going to examine a day when the global financial system nearly broke, and not because of a war or some sudden economic depression. No, this was caused by something hidden deep, deep within the market's own architecture. I want you to imagine a market crash so fast, so furious, that it happened with no obvious trigger, and the culprit might have been something entirely new: computers. Well, we're looking at October 19th, 1987, infamously known as Black Monday. This was an entirely unprecedented disaster driven by a totally new kind of suspect, a suspect that literally transformed a normal market correction into a runaway freight train. All right, let's jump straight into Section 1. The impossible crash. To really understand this mystery, we first have to look at the sheer scale of the carnage. The Dow Jones Industrial Average plummeted 508 points in a single trading session. That is a 22.6% drop. Just think about that for a second. To put it into perspective, this record still stands today as the largest one-day percentage decline in history. It completely blew past the 12.8% drop of Black Thursday back in 1929. The speed and depth of this fall left traders absolutely paralyzed on the floor of the New York Stock Exchange. And globally, the losses were estimated at a staggering $1.71 trillion. And remember, we're talking about 1987 here. In a matter of hours, monumental global wealth was just erased. Because financial markets had become so highly intertwined technologically, the panic cascaded across time zones, starting in Asia, moving to Europe, and finally hitting the US. It sparked immediate, genuine terrors that a new Great Depression was already upon us. Look at this intraday chart for the S&P 500. Look at that cliff. This wasn't some slow, gradual bleed out. You can visually trace just how steeply and relentlessly the market broke down all day long. There's a massive drop right at the opening bell, a super brief moment of confusion where it kind of stabilized, and then just a terrifying, unyielding freefall right into the close. The trading volume that day, it was 3 times the daily average, absolutely wild. Which brings us to Section 2, hunting for a trigger. So the immediate question for economists was, what macroeconomic event could possibly justify this? Investigators quickly rounded up the usual suspects. I mean, the market had been on an incredible bull run since 1982, so a correction was definitely due. There was a wider than expected U.S. trade deficit reported the previous Wednesday, global interest rates were rising, Congress was floating new tax legislation threatening corporate mergers, and, international currency agreements like the Louvre Accord were looking a bit shaky. But here's what you really need to take away from this. While these factors certainly created some anxiety, mathematically, they were entirely insufficient. You don't get a 22% one-day freefall from a trade deficit report. You can see here how rapidly the S&P 500 and price-earnings ratios were climbing in the years leading right up to the crash. The market was undoubtedly overvalued and ripe for a pullback. But the true mastermind of this crash wasn't just investor sentiment or macroeconomics. The real danger was lurking completely out of sight, deep in the market's plumbing. Let's dig into that in Section 3, Rise of the Machines. This is where we meet the real culprits of our mystery: nascent, automated computer systems. During the 1980s, large institutions started relying heavily on something called program trading. Basically, pension funds and mutual funds started using computers to buy or sell massive baskets of stocks. We're talking over $1 million at a time, the exact second certain conditions were met. Thanks to the New York Stock Exchange's automated DOT system, this completely removed human judgment from the moment of execution. Millions of shares could now be dumped blindly in mere seconds. And the absolute most popular type of program trading was known as portfolio insurance. Major institutional investors honestly thought this software gave them bulletproof protection against losses. It was a dynamic hedging strategy. The idea was, instead of selling actual stocks when the market dipped, the computers would automatically sell stock index futures. Investors treated this algorithm like a magical safety net that would cap their downside risk while letting them soak up all those sweet bull market gains. But here's the crucial thing. These mechanics were incredibly rigid. Here is exactly how it was supposed to work. Step 1, stock prices drop. Step 2, computer models instantly recalculate the portfolio's risk. Step 3, the system automatically fires off sell orders in the futures market to hedge against those losses. The computers were explicitly programmed to sell simply because prices were falling. No human intervention, no common sense reality checks, just pure, relentless, algorithmic selling. And that leads us to Section 4, the cascade effect. So what on earth happens when everyone's computer is programmed to sell at the exact same time? You get a fatal self-reinforcing doomsday loop. This perfectly illustrates the cascade theory of the crash. As the market opened lower that Monday, portfolio insurers systematically sold massive amounts of futures. Since literally everyone was selling, futures prices violently plummeted below the value of the actual cash stocks. This triggered a second type of program trader, index arbitrageurs, who saw a chance to make a quick buck. They bought those artificially cheap futures and immediately dumped the real stocks on the New York Stock Exchange. That massive dumping drove stock prices even lower, which, yeah, you guessed it, signaled the portfolio insurance computers to sell even more futures. It was a terrifying feedback loop, completely decoupled from fundamental reality. Trace this hour-by-hour chaos with me. At 9:30 a.m., an avalanche of overnight sell orders meant a lot of stocks couldn't even open, which created stale, totally inaccurate market prices. By 11:45 a.m., the panic was so intense that options and futures exchanges in Chicago actually started halting trading. Around 1 p.m., a misunderstood comment from the SEC chairman sparked rumors that the entire New York Stock Exchange was going to be closed, causing traders to desperately dump assets so they wouldn't get locked into terrible positions. By the 4 p.m. closing bell, human market makers were totally paralyzed, but the machines, they just kept firing until the market was utterly decimated. And behind the scenes, things were even scarier. The physical pipes of the market nearly burst. Liquidity just evaporated. Massive drops triggered historic margin calls. These are demands for immediate cash to cover losses. Brokers literally ran out of cash to pay the Chicago Mercantile Exchange clearinghouse. Major settlement banks were hesitating to extend credit because they were terrified of exposure to failing firms. We were inches away from the total insolvency of major clearing firms. Let's look at how this was stopped in Section 5, the Fed steps in. With the global credit system on the brink of freezing completely solid, an unprecedented rescue mission was launched. Before the markets even opened on Tuesday morning, the Federal Reserve released a simple one-sentence statement. It read, "The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." Those words acted as the ultimate circuit breaker for human panic. It signaled to everyone that the central bank absolutely would not let this system collapse. Under their new chairman, Alan Greenspan, the Fed executed a swift and multifaceted playbook. First, they immediately dropped the federal funds rate from 7.5 to 7.0% to ease credit. Next, they flooded the market with cash by conducting massive open market operations, specifically injecting highly demanded Treasury securities through reverse repurchase agreements. But most importantly, the Fed got on the phone and aggressively urged major New York banks to keep lending money to struggling brokers so they could actually meet their margin calls. They made sure the money kept flowing. So what was the result? Well, despite this historic, terrifying drop, the broader economy remained entirely intact. There was no recession following Black Monday. In fact, within just 2 trading sessions, the market had regained 57% of its losses. The underlying companies were totally fine. It was the trading mechanisms, that blind faith in portfolio insurance and automated liquidity, that had fundamentally broken down. Today, of course, we've installed circuit breakers to pause trading during extreme sell-offs. But as we look at our modern markets, which are driven by hyper-fast AI and algorithms infinitely more complex than those of 1987, we really have to ask a hard question. Does the rise of AI in trading make another Black Monday inevitable? Share your predictions in the comments. Thanks for joining me for this explainer, and remember to always keep questioning the mechanics behind the numbers.